Okay, good morning, good afternoon to some of you. Today is Wednesday, March 10th. A couple interesting charts to share with you guys. One of the most common questions we get over at Coro is what on earth is going on with gold prices? What are the factors that influence it to go up or go down? Now, obviously, what I'm going to share with you guys today, this is not investment advice. This is just educational oriented, but want to give you guys some perspective coming from a background in doing global macro trading for the last 2.5 decades. Now, one of the things that we look at is we look at the yield on the 10-year Treasury bond. And right now that yield has been going up a lot. What you're seeing here on this chart is in the top panel is the yield on the 10-year Treasury, which you can see over in the right-hand side of this chart has been cruising up. I'm going to show you another chart in a moment so you've got some context for just how much. And you're also starting to see that the dollar index is also starting to go up. Why is this happening? Is it because the dollar is a great currency? Certainly not. But sometimes it's kind of the dirtiest, cleanest shirt in the dirty shirt pile that markets choose to put on. And in a market where rates have been negative in many other parts of the world and you can't get any yield, pension funds in Europe and Japan do find that yields in the US are attractive. So let's take a closer look at that and see what that looks like. Here on this chart, what I'm sharing with you guys, this is an overlay. This is actually the 10-year yield, that same one on the other chart. You can see the line in white here, versus the NASDAQ. Now, as you guys have heard in the news, and if you're following markets, you've seen the NASDAQ been selling down. Companies like Tesla are trading down, MicroStrategy, pretty much the entire index has been coming down. And when people ask why, what is the narrative that's going on out there? Well, if rates go up, it costs companies more money for their financing. And so this is just classic basic financial math to use. Now, what's interesting to us that we think that the market is not paying close enough attention to, it's not just that 10-year yields are going up. It's that they're going up a lot when you look at that on a percentage basis. So we can see during the low of last year, the yields were a little touch below 50 basis points, but now they've made a huge move, 213% increase in the yields. Now, going from 50 basis points to 150 or 1.53%, which is where it's at right now, these are still very low yields. But from a percentage term in movements, this is a large movement, and this is something to keep an eye on. And it's no coincidence that you're seeing NASDAQ sell off with some of these concerns as highly levered tech companies that have borrowed at cheap rates, and pretty much every public company in the market has to face higher costs of financing. Now, just one more chart for you guys before we wrap this up is I thought that it would be useful for you guys to be able to see what it looked like during the last technology bubble. And sure enough, we see a similar pattern. We see that rates on the 10-year yield, they cruised up 63% in this situation right before the NASDAQ peaked out and then had a huge drop down. Now, if only it was so easy to look at rates and say that when rates go up, markets will come down. It's not so simple. There are a lot of other moving parts when you're looking at macro. There are times when rates can go up and markets go up at the same time. But the point today to share with you guys is that looking at the yield on U.S. Treasuries is an important factor. And if the yield is going up while we have mountains and mountains and mountains of government-issued debt, and we can't afford to roll over that debt, then the yields matter more than they ever have in the past. So just want you guys to be conscious of that, paying attention. I hope you find this helpful. Give us some comments on the Coro chat. Let us know if you like this, and we'll produce more for you. Have a great day.